Firstly, thank you for joining. I know it's a short notice because we got the time mixed up.
Yes.
But as always, always, there's a lot of people interested in hearing from you and hearing your views on the markets. So with little effort from my side, I'll just would hand it over to you. Everybody in the audience is familiar with you, and uh, they have learned immensely from you in your previous webinars. So, Dr. Salman, would love to hear from you. What do you think? How do the markets look like in 2023?
So good morning, good afternoon, everyone, and thank you, Ali. Sorry for the slight confusion. We had dates confused, but it's lovely to be here. So I can start a little bit with how we are seeing the different dynamics taking shape going into 2023. In fact, 2022 is still not over. I mean, you saw the Bank of Japan change its policy yesterday as well, which was, timing-wise, it was a shock. But I guess in terms of the direction of moves, it wasn't. But let's take a step back and understand both from a short-term and medium-term perspective what is happening with the global economy and the global financial system. So the pandemic shock created obviously this very powerful policy mix of easy monetary policy, ultra easy monetary policy, and very generous fiscal stance in especially in key developed markets. We had a supply shock which passed through the system as well as we know, because of the lockdowns and the restrictions which happened at different points in time in different countries. But as we started 2022, we realized that, at least the key central banks realized that, this inflation is not just supply driven. We had done quite a bit of work in 2021, understanding the different forces and components of inflation in the US, and we thought, okay, some of them look very persistent and also linked with the demand side of the economy. And of course, the biggest factor and the statistic you can quote to show the evidence of overheating economy is the unemployment rate in the US. It was incredibly low as we hit the cycle lows as the stimulus passed through the system, and we saw a shortage of labor, both from a supply side issues and of course the increased demand which came through as that fiscal stimulus started getting spent. So fast forward, what key policymakers became hawkish at the same time, led by the Fed. Their intention was to bring inflation down. Firstly, they were signaling policy tightening, and then by August, Jackson Hole, if you remember, they started delivering on very significant policy tightening. And that's where we stand right now. So significant amount of policy tightening has already been delivered, especially by the Fed. Our base case is that the US economy, and has been for a while now, that US economy will suffer a recession. This tightening is quite significant by historical standards, both in terms of the time span it has taken place and in terms of the magnitude it has happened. In fact, unconditional estimates of unemployment rate increases as a result of this tightening is around 3 percentage points, which would historically put you at a very, on the deeper end of a recession, so big recession, if you will. But there are important mitigating factors, like the refinancing flows are more benign in 2023. The corporate side of the balance sheet is, even though very levered, a lot of that refinancing comes through 2024 onwards, and the corporate and the consumer balance sheet is sitting on excess cash and deposits and hasn't levered up that much compared to what we saw, pre-GFC. But the interest rate sensitive parts of the economy are shaking across the board, where interest rates have gone up significantly. So it's a more flow pressure on the housing market we are seeing right now. And the best outcome to our mind is that you get a cyclical recession right now. We are not in the camp that we will get away with soft landing, given how significant this tightening is, and the fact that this is a slower moving shock than we have been used to the last 15, 20 years. Europe has its own issues with the energy shock. The good news for Europe has been that the weather has been quite mild, apart from this cold snap which happened a few days ago. But overall, has been quite mild compared to historical standards. So the gas demand hasn't surged up as much as in the normal weather. So that means you didn't have to have blackouts. And the storage has been quite high as well going into this winter. So the mildness of that weather has played a big role in delivering a much lower than expected intense economic shock over this winter period. But still, the problems are medium term there. We're going to have another round of issues next year as Europe tries to shift away for its energy security system away from Russia to much more diversified source of energy. And then we are differing from consensus is China. We are positive on China. The change in COVID policy was quite rapid and significant. In the short term, you're going to have a very big surge in cases with unfortunately increase in the death rates. But as the surge passes through and the vaccination rates pick up quite significantly, as we are seeing in the data, we do think that China will be fully open by second half of next year, and that will create a lot of pent-up demand to be released from China. That's something to keep in mind for commodity prices, because China has been one of the major issues. Like oil, for example, didn't do as well as it could have because of the supply side issue we got from the war in Ukraine. So all in all, we are expecting and projecting recessions for some time now, and we do think the data will start to come under pressure. Inflation has peaked to our minds in the developed world, but there's a cost to bringing that inflation down, and that's going to be in growth. And that's why we think that especially equity markets are still quite vulnerable. That said, recently we have become quite bullish on bonds, and at any sign of weakness, we do buy bonds. We think yields can stay at these levels or even a bit lower as the Fed starts to then shift gear towards fighting inflation to fighting growth as we pass through into 2023. That said, ECB and BOJ are catching up with the hawkishness, especially given their own situations have diverged from the US. And that makes the dollar vulnerable here because the terminal rate in the US is now more or less confirmed that it's going to be around 5%. But that's not the case in Europe or Japan. We don't know where the terminal rates are. And that makes dollar vulnerable. So it's a very different from previous cycles where when US recession came through, dollar used to do well. But this time around, dollar has contributed to the recession, potential recession. And that means that interest rate differential will start to move against the dollar as the other central banks catch up with their hawkishness, whilst equities may diverge away, and they are the problem areas for us because I think the earning forecast is still quite positive, and we do think that growth pressure will mean that you can get further pressure on equities before we have seen the bottom. What are the positive risk scenarios and the negative risk scenarios around it? The positive risk scenario is that this indeed goes into a soft landing scenario because supply side relaxations continue further from here and bring inflation down with it without major damage to growth. Of course, the data will be the key barometer of that. And the negative scenario is that the Fed keeps rates longer at these higher levels, just increasing the probability of a balance sheet issue in 2024 as a lot of debt starts rolling over into this very high rate, which is not happening at the moment. It's all cyclical new flow, which is under pressure, not the balance sheet yet. But there's a window of opportunity and time here. But as we go closer to 2024, that may change. And then, and of course, as we learned from 2022, left field events can happen. I mean, the war was completely left field in terms of how it broke out. But at the same time, any movement on that front would be important to watch. Although it looks completely very messy and and very complicated and with important medium-term implications. But we have to keep an eye on how that situation pans out, especially for Europe, will be an important one. So I'll pause here and hand over the floor to you, Ali. And if you have any questions or any thoughts, more than happy to discuss.
Thank you for that insight. And I was just, while you were talking, I was thinking that just this morning I was reading BlackRock's forecast outlook for next year, and that was also seemed very similar, that they think that there will be a recession, and they think that equity markets are not yet pricing in because the forecasts are still, earning forecasts are still quite optimistic. So between you and BlackRock, I think you are probably, you guys account for like 25 to 30% of total asset under management. So it seems as if, like, is this the consensus view that equities, bearish on equities, do you think? And secondly, you mentioned about dollar, which was very interesting, and of course has greater implications for Pakistan. Do you have any views on precious commodities such as gold and currencies for, like, of course, Pakistan has Pakistan-specific issues on the exchange rate, and that's why I thought that perhaps gold versus dollar might be a better proxy for the global macro conditions.
Sure. So, I mean, the consensus view on recession is coming into play. I think there was this period a few weeks ago when people started talking about soft landing once again. If this recession were to come, it will be a well-telegraphed and recession. There's no doubt about it, because of the policy shock. Because this is a policy-induced recession. This is not an external shock-driven recession. And the market pricing will have to come through around that. And the reason why we are cautious is that the equity markets, even though this is consensus by talk, but you don't see that in the prices. I mean, equity markets are not priced for recession. I mean, maybe credit markets are, especially IG. So we run these metrics across different markets. So IG looks priced for recession. Equities don't. So we can keep saying that as a consensus, but equity markets valuations are not consistent with the recession, and the earning profiles and expectations are not. So there is a discrepancy between what is happening on the top downside versus what we see on the earning profiles. To your question on the dollar itself and implications for Pakistan, certainly I think the dollar, obviously, as I mentioned, was a major contributor to the tightening of financial conditions which happened globally and for US. It was a result of mainly a result of a very hawkish Fed policy, which is now being maintained at a hawkish level. If you see my point, the delta has reduced. So you're not talking about 6% Fed rate or 7% Fed rate anymore. More or less 5% is where the market's pricing are converging towards, and we see fall in the bond volatility as a result of it, as a reaction function becomes clearer. And other central banks are catching up in terms of the hawkish. The ECB was very hawkish, and you saw the BOJ pivot as well. So we do think dollar becomes vulnerable here, but against developed markets, and the EM, specific EM idiosyncratic stories will continue. So I don't think Pakistan is in that zone where Pakistan can linearly trade with the dollar. I think oil prices are probably much more critical in that regard. So Pakistan is almost default risk category. So you have these massive idiosyncratic risks for Pakistan, which are in play. But generally for the rest of the world and major mainstream EMs, dollar pressure will start to ease. In terms of gold, yes, I think as real interest starts to normalize, I think we'll probably see gold doing a bit better. It has been very resilient to increase in yields. I mean, it could have gone much lower given how significant the increase in yields was. But I think overall, from a SAA perspective, we do think gold is a very interesting, important inflation hedge in portfolios, and it has a role to play. And then of course in Pakistan, where the country level uncertainty is quite high, it has another additional role to play as a hedge.
Thank you. I have two more questions, and then I'll open it up for the audience. I'm sure the audience have a lot of questions to ask you. Firstly, on I think somebody's also already asked that questions, but like on oil, and you have been perhaps the best reader and forecaster of oil markets over the last 3 years. You predicted the decline, you predicted the recovery. What do you think about global oil prices now?
So I think just to give you some numbers on that, I mean, China's ZCP or zero COVID policy more or less contributed to 1 to 1.5 million barrels lower demand this year. And we know that the rule of thumb is a million barrels comes through. You talk about $25 to $30 extra on oil. That's a rule of thumb, and then you can add some stress risk to it, at least short term. So we do think that demand comes back, especially in the second half of next year. And then OPEC Plus policy has been cautious on the supply side. We do think we're thinking that this now goes into a wide range action from here. So 75, 70 as a lower bound, and 100, 110 as the upper bound to oil, and we swing around that because you have a potential surge in China, but then obviously you have a cyclical recession issue coming in US and demand destruction in Europe. I mean, there is a structural reduction in demand for energy, which is coming through in Europe as awareness about energy efficiencies has increased. So, people keep on talking about, can we deliver climate change? Yes, we can by prices. When prices go up, people change their behavior. In fact, those behaviors don't come back, even if prices start to improve. Once you know that you can save energy and your awareness of the whole system increases, I think there can be permanent destruction of commodity demand as a result of that. But it's more to do with gas, but I think oil does play a role there. So you have a push and pull there because China comes back, supply on the tighter side. Russian supply is not coming back. You will have more stranded Russian supply going forward because of the energy caps and other issues. But then you have potential recession in the US and Europe, which will do demand destruction. So as I said, I think we are in that broad range now. So we would buy at 70, look to sell at 100, 110 as the ebb and flow continues between the demand and supply factors.
Thank you. And Dr. Salman, you are one of the people who have great insights into China, especially their economic and financial systems. What do you think is happening in China? And do you think that the policy of opening up of the COVID restrictions will lead to a significant rise in COVID cases? And is there a risk that COVID can then spread across the borders? Do you see that as a threat to Pakistan being a neighbor of China? And also economically, the news coming from China has been very mixed. So what are your latest thoughts on China's economic policy, especially I'm referring to vis-a-vis the Belt and Road?
Sure. So short term, we know the cases are going up, and that's not the official case count. Obviously, that's not moving at all. It's more to do proxies like internet searches being overlaid on historical case reporting. So one of my China analysts thinks that the true case is around 3 million a day or something. So rather than thousands you're talking about in the official data. But 2 points I would mention that if you look at the vaccination profiles, almost everybody got the first one, but till the ZCP wasn't released, around 60% had gotten the third one. So now it is picking up. In fact, China for a longest period was deploying only 150,000 vaccines a day. Now it's first it shot up to 1 billion a day, and now it's going up further. So one begs the question why vaccination rates stalled in China. Obviously, they were doing a lot of PCR testing, but vaccination rates did not pick up. And then, of course, the mRNA vaccine. So Pakistan has a higher incidence of mRNA vaccine, which is not the case in China. And we know mRNA has been very effective at dealing with Omicron. Now, in terms of risk to other countries, unless until this creates another variant, I think that's the risk for the rest of the world. Always the same risk, as we know, that you have a variant which starts to evade vaccines, and then you have to go back to square one. But Omicron is a very fast and agile variant we saw, because it has been, it has been leading all the variants for some time now. If you remember, Beta came, Delta came, they had their day, but since Omicron has been in and dominating, no other variant has managed to upstage it, because it spreads very fast, and it's not very it doesn't kill that much, if you see my point. So it has those two things going for it as from a virus variant, that it keeps, because if you think that the key aim of a virus is to stay alive and replicate, it's quite tuned to that in terms of the parameters. So less concerned about it because of the Omicron's attributes, which have been well studied now. Apart from China, everybody else started living with the virus, and has a lot of data to understand its different attributes. And I think what gives me heart is that that variant hasn't been upstaged, despite the fact that 7 billion of the population is living with it. I mean, it's only 1 billion of the population which was not yet ready to live with that virus, but that is changing now. But the rest of us have been living it for months now. So that gives me strong hope that this natural immunity and herd immunity will start to come through in China, like it did in the rest of the world.
I am getting a lot of questions, so I'll jump into the questions, and I'll come back to the second part of my question about like China and Belt and Road. But moving to I'm just reading the questions. It's asking, in the grand scheme of things, where do we stand in the debt cycle? And we have seen the US buy back US dollar relatively aggressively lately, and gold is at an all-time high as well. What are the chances of hyperinflation, as the US dollar is a world reserve currency?
I think on hyperinflation, given that how the key central banks have reacted, I think the probability of hyperinflation type environment has reduced quite significantly. I mean, you have QT going on, it's quantitative tightening in the US. If you look at the market pricing of break-even inflation, despite all the shock and increase in oil prices, and then of course the COVID shock, we still see break-even at markets see break-even at around 2.3 for the next 10 years. Although I think that's lower than what would be the ultimate outcome, which would be more like 3% average over the next 10 years. But the hyperinflation core parameters are not met. You have central banks which are very hawkish. They are willing to bring recessions to bring inflation down, and then you have obviously liquidity being withdrawn from the system. So Bank of Japan was the last one to do that, was the last one providing liquidity, and that is now coming out as well. I mean, hyperinflation is probably a risk for Pakistan, but not for the rest of the world. Yeah.
Got it. Bilal has asked, and I've already asked you that question, so that how do you see energy prices responding to recession, especially given the milder winters and higher inventory levels?
So I think I mentioned to earlier, I think the China factor is the offsetting the recession. The US and UK, US and Europe will be an important one to watch. And then, of course, the supply side is on the tighter side. And Russia crude will become increasingly stranded. So we should not just take a straight line that US recession is happening, oil will go down. It may swing in a wider range because there are other factors in place as well.
Related to that, Fazan Kamran is asking, what are your views on the outlook for commodities? He's mentioning that your former employer, Goldman Sachs, issued a note expecting a 43% return in commodities index in 2023. So with expectations of a recession ripe in 2023, do you expect some cooling off of commodity prices?
I think there will be some differentiation, further differentiation there in commodities. We have to be careful about two things, in the sense that industrial commodities will react more to Chinese demand. We'll see what kind of Chinese demand comes back and what will be their focus on infrastructure spending. I think that can, from base metals perspective, that will be very important. Oil, I already discussed. It can move in a big, wider range. Now, food is the interesting one, because obviously we had a structural shift in supply of food because of the Ukraine-Russia war, and how much wheat will come through again. You already have problems in the sowing period this time around because of the war, and weather itself plays a big role in terms of the harvest season. So that's something to keep an eye on. You can get another food price shock as we move towards the middle end of 2023. But I'm less sanguine about that 43%. I think that view holds over a multi-year period because there is structural underinvestment in commodities. But the recession views are strong enough for us to be a bit careful, even though China is going to come back in a big way in the second half.
Got it. Satish Balani is asking that sometimes back there was noise around Evergrande default and Chinese property developers. Do you think China will be the new center of the next recession?
Look, in the last few, beyond ZCP, there's a lot of policy changes which are coming through to put a floor under the property market issues. It's quite weak right now. If you look at all the different metrics of activity in property market, prices are coming down, sales are coming down. The investment into that real estate sector is under pressure. But there are trust funds being formed to help some developers, incentives being given to home buyers. Credit stimulus is being targeted to some sectors again. So the idea is not to create a re-leverage or upswing cycle. The idea is to start to put a floor under the deterioration. And I think once ZCP and zero COVID policy was playing a further role in depressing sentiment on property. So we don't think that property will come back in a big way, but we do think that the deterioration will ease, and really zero COVID policy will be the swing factor. And I think the best way to look at it is if you chart retail sales in China pre-pandemic and extrapolate that trend, and then look at the gap where we are right now. There's a lot of pent-up demand there. Savings have gone up. And we saw that in the West. We saw that in other countries when opening up happened, what kind of surge you can get in demand. So that will overwhelm any structural issues we have on the property market, at least for 2023.
So as you said, you're slightly bullish on Chinese equities.
We are. The valuations are quite compelling. Obviously, it's quite a volatile market, so you have to be careful in terms of position sizing. But from medium perspective, we are positive on the areas which are connected to consumer in China and the rebalancing in China. Not all of them, I think, but China is a big market. And then if property is no longer going to be used as a saving vehicle for the retail and individual investors, then that flow may also start coming back into equities. That's something to keep in mind as well.
Makes sense. A big question now from Hassan Raza, and he's asking about Pakistan. His question is, given how Pakistan has been acting with regards to managing its external liabilities and the IMF program, what do you think of Pakistan? Will it survive the default? If not, which path do you see for Pakistan? The Sri Lankan path or the Ghana path, or any third way? maybe Lebanese, and that's what I'm adding. And how can investors prepare for it in terms of asset allocation? US dollar and US dollar linked assets is one thing, but what about government bonds, REITs, stocks? So a big question, but it's a timely question. Any advice on asset allocation in given the scenario Pakistan is in? Any lessons from Sri Lanka, Ghana, Lebanon?
Um, I'm most certainly it will be a Pakistan way, rather than any of because I think we have our own peculiar issues and peculiar circumstances. But I understand the challenges of asset allocation in a country situation where default risk is so elevated. Now, that's why, from an asset allocation perspective, is diversification has always been touted as the most important free lunch, which is available, and geographical diversification. It's the currencies, having a defensive asset classes mixed with growth asset classes. All the structure of how we build asset allocation frameworks, where you mix a hope with fear, right? I mean, that's ultimately what you're doing in asset allocation. The problem with Pakistan is, and if you're invested in Pakistan, is that you can't get out now. Capital controls are quite tight. So that diversification angle is short circuited, and you can understand why, because if everybody has the same idea, there will be a run on the country, right? I mean, we see my point, because of the way the view on the whole economic and financial system is changing. So if you are within Pakistan, I would suggest that nominal asset classes will suffer, because inflation is going to be the way how that is taxed. Now, people think that economics is very complicated, but at some levels it's very simple. We know that Pakistan's tax to GDP ratio has been one of the lowest in the world, lowest in the EM world for a while now. Our generation, our previous generation, and probably every person who has some understanding of economics has been saying that since I started understanding economics. But the system, balances out. Now, with inflation so high, what is happening? The whole system is being taxed, because we did not deliver accumulated savings back to the public sector in a way which would make a difference. Now, I don't want to go into the governance arguments, but I'm just talking about the numbers here. Even the numbers are weak. You can say, oh, what would have happened if those ratios were much more, i.e. the tax to GDP ratios were much more normal. They were not, firstly. They were very abnormal if you compare to India, Bangladesh, and for many, many years. The reality is that private sector in Pakistan did not pay taxes and did not contribute to the saving surplus, which was needed to strengthen the underlying economy. Now the result is that inflation will come through and everybody will get taxed. With capital controls, you can't escape that taxation. That's the ultimate macro policy adjustment which is happening. Now it's painful, but it makes sense, because that's how the system has to adjust. You can't create magic money. Unless you are the US. You have to be a reserve currency to create magic money. Pakistan cannot do that. Now, from an asset allocation perspective, is that again, if you are firstly have constraints of capital controls, the question would be how to protect yourself against this inflation taxation which is happening. So real assets will become important. Anything which can hold its value against inflation. Second would be that I think gold has a role to play. And then within equities, I think from a more, if you can take a longer term view, companies who have able to pass on prices, create, have or those sectors which will benefit from the new economic model, which will have to arrive at some point. The problem right now is that unlike the previous crisis Pakistan had, there is no bailout happening in a big way. which changes the scenario quickly. And that's what a lot of us in Pakistan have been used to. You go to the brink, bailout happens, here you go again for the next cycle. But what we missed is that every time you go to the brink, you become weaker and weaker, and on the third or fourth time, it becomes very difficult to get up. So my main suggestion is inflation hedging is going to be the way you have to understand those asset classes and understand those assets which can give you that inflation hedge, because ultimately you're being taxed. If you're in Pakistan, I mean, I have assets in Pakistan, so I realize how I'm taxed on them. It's not the government which is taxing; it is the system. It's creating that revenue flow back to balance the books, really. And it's economics 101, but we don't learn, so there's not much I can to add on that one.
Indeed. Two more questions, Dr. Salman. I'm conscious of your time. We have the last 10 minutes. The first is Bilal is asking, it's an extension of the last question, which is in terms of, are there any particular sectors of the economy which you think will do well in the coming months? And he's talking about he's asking in terms of the global economy. So in a recession, what do you like? Healthcare?
Yeah, we like healthcare from a structural theme perspective. We like renewables. They have become quite cheaper after the growth factor pressures. Structural themes are there. Cybersecurity is another one which we are focused on. Defense is going to be a very important theme to think about. And then I think ultimately, immediately, we do like IG credit and the extra yield which is available as we set ourselves for a recession. But there are obviously structural themes. And then emerging markets wise, we like ASEAN countries which would benefit from China demand. Indonesia is there. Some concerns on India because of valuations in expensive market, but structural winner out of the geopolitical and geoeconomic situation. And then LATAM on the other side, especially Mexico, which will benefit from reshoring coming from US. So they are quite regional winners which will come out in this new system, which also sees US-China decoupling, of course.
Thank you. And there are two more questions. So the next question is, I'm rephrasing the question which has come from a few people. They're asking that, do you think that now we are in a regime of higher interest rates globally? Because there's some commentary that the global economy has ended up where it is because of this period of low interest rates. And I'm adding on to that question because, I thought that the thesis was that we will have lower for longer because of the demographics of the aging population. Has that changed now?
Look, I think deglobalization is inflationary because everybody starts to build their supply chains themselves, so efficiency goes away from the system. Decarbonization is inflationary. And debt reduction also needs higher inflation. So there are forces and demand for higher inflation, which will potentially play through and lead to higher average inflation. So our thinking is, inflation averages 3% plus over the next 10 years, then the less than 2 it has over the last 15, 20 years. The demographic angle is there, but once you have countries aging at the same time, that labor supply shock can actually overwhelm the demand issue. So if you have people getting out of the labor force faster than the change in their demand. So Japan is where you learn the idea that demographics is deflationary, but Japanese aging and demographics play was happening at a time when China was coming to the global labor force. So i.e. net excess labor supply was growing. So I'm not quite sure how demographics will be deflationary when global labor force is contracting. So there's a labor supply shock. Now that leads to new technologies, robots and automation and other things. But it can be an ambiguous effect on inflation. I mean, it will depend a lot on those technologies which replace that labor supply, because if aging and longevity is also in play, then demand stays while supply reduces. So I mean, it's a complex topic. We have published quite a bit on it, and happy to share our detailed thoughts on that.
Thank you. Would love to get a link of that and share it also with the colleagues here on the call. The last question, and it's a more philosophical question, but people are asking. Locally in Pakistan Stock Exchange over the last couple of days, the market has declined quite significantly, hitting the lower thresholds in terms of the locks. So people are asking that, how do we invest in a recessionary environment? Do we say that we are long-term investors and hold on to what we're holding, or try to be contrarian, or do we get out of equities altogether? What's the best way? How is the best way to play a global recession?
Well, from a global recession perspective, the thing is that you have to buy when you think the pricing of that outcome is in your favor. So, like for example, in US, the pricing of PE ratios is not consistent with the recession. So you're not, from multiple perspective, getting paid for it. Earning profiles are still positive. So we do think that you need everybody to tell you there's a recession, which is, I think that condition is starting to get met. Then valuations have to be cheap. They're not cheap yet. And then thirdly, positioning has to be lopsided, and it's not. So, and then the macro data needs to stop deteriorating fast, and it has just started deteriorating. So multiple tests based on historical experience you can use. And apart from the first one, which is that people are a lot more thinking about recession now than they were a few months ago, it has been met, but nothing else. So in terms of the horizons is important, as you said. If you are a strategic asset allocation perspective, then yes, equities have to be there, but they have to then compete with fixed income and relative valuation. So if you take a look at our new SAs, I mean, they are more heavy on fixed income than they were a year ago. So your allocations are shifting because relative valuations of asset classes are also changing, and then we are also introducing inflation hedging into our portfolios wherever we get opportunities for cheaper assets to come through. So I think the horizons question has to be calibrated with, the technical asset allocation horizon as SA has to talk to each other. And ultimately, the aim is to obviously create real return for our investors with the minimum possible volatility. But this volatility is something which will create value for sure.
That's very interesting. And last question, I'm curious, and this question is for me. I'm curious that if your fund manages a few $1 trillion, so when you see these kind of swings in the market, do you, for example, you become bearish on a sector, say, let's say cyclicals or stocks as equities in general? How quickly do you move, and how sharply do you move? As in, from your asset allocation perspective, do you tell your equity guys, guys, sell everything you have, no matter what, or do you say that we are long-term holders, so we can reduce a little bit and then add an average down? And then how does the thinking process and the asset allocation process works on that?
So it varies in terms of the mandates and strategies we have got. So the single building block strategies will have a certain amount of risk budget to give you that flexibility. So I mean, the extreme is hedge funds, which can do anything. If you see my point, the absolute return strategies, so they can go to cash, they can long cash or leverage, use leverage to express their views. But on more long only, the usage of leverage is limited and very clearly spelled out, and the risk budget is, think of a risk budget as your space degree of freedom. So that degree of freedom will vary if you're an equity manager or a fixed income manager. But ultimately, the asset allocation side where we sit, we can change allocations quite rapidly between equities and bonds, if you will. But once you go into the single asset class lines, degree of freedom is determined by how active you are as a manager. So it's a bit more complex than having a top level few dimensions. It's multiple dimensions, but ultimately also the mapping of different asset classes. So we are mostly on long only side, but the absolute return or hedge fund strategies, as you know, Ali, can be far more flexible in dealing with market opportunities and issues.
Thank you, Dr. Salman. This was extremely insightful, and we learned a lot. There were still a few questions pending, but I'm conscious of your time. So I know you have to take a call. So thank you so much and have a good day. And for the audience, have a good evening.
Thank you very much. Thank you very much. And sorry for the delay earlier. Thank you.